Hey folks, welcome to a product review at Finominal. Today we're going to look at private equity ETFs. Now, for the avoidance of doubt, this is not ETFs that allocate to private equity funds. This is simply ETFs that provide exposure to listed private equity fund managers, like a KKR or Blackstone. Now, in the US, there's three of these. There's the White Wolf publicly listed private equity ETF with the ticker LBO. There's a product from ProShares with the ticker PEX, and there's one from Invesco with the ticker PSP. The total AUM of these three ETFs is less than 500 million, so quite small. And the fees they charge are quite high, with around 65 to 75 basis points. In terms of portfolios, these are quite concentrated. So the number of stocks in those ETFs ranges between 39 and 68 positions. And we can also have a quick look in terms of what kind of companies we find in these ETFs. So here's a look-through analysis to the top 10 holdings. And the number one stock is RS Capicorp, followed by Hercules, 3i, which is a British firm, KKR, a US firm, and Sofina. Now, let's have a quick look in terms of how similar or how different those three ETFs are. If we look at the kind of fundamental breakdown of these ETFs, it's of course all equities, but from a geographical perspective, there's quite significant differences. So LBO only owns US stocks versus, well, PEX and PSP, right? They effectively have a much lower allocation to the US and significant international exposure, as per their names, right? Global listed private equity, global listed private equity. So that's worth keeping in the back of our minds, right? That these ETFs do have different geographical exposures. We can also have a look at like a factor exposure analysis. So, and let us change the benchmark to an MSCI World. That is simply because two of those ETFs, right, have significant international exposure, and plus all the large private equity firms do invest globally nowadays. So over here we do see effectively those three ETFs versus the MSCI World on a number of different fundamental metrics. So these are the current portfolios. We do see that the average stock within those portfolios, those three ETFs, are cheaper, than the average stock in MSCI World. We do see from a EPS growth perspective, they tend to have lower growth. We do see from a momentum perspective, they tend to be, well, a little bit weaker. And also from a profitability perspective, these companies don't tend to be as profitable as the average stock in the MSCI World. Now, we can change your perspective and go from factors to sectors. And that simply highlights, which also explains some of those factor exposures we just seen a second ago, that compared to the MSCI World, which is the kind of like purple bar over here, all the stocks in here are financials, right? Because the Blackstone and KKR, that's a financial stock. Versus in the MSCI World, you only have 15% in financials, but you got 37% in information technology. And of course, that also explains the factor exposures, right? We saw that the average stock in those PE ETFs, right, is much cheaper, right? And financial stocks tend to be cheaper than technology stocks, and so on. Also less profitable, right, and low momentum recently. Now, that's with regards to in terms of how similar those portfolios are, right? So there is a bit of overlap, right, from a factor perspective in terms of how the characteristics of the stocks, but there are differences from a geographical perspective. Let's move on to performance and risk, and we can only see the performance since, well, December 2023, and that's simply because the White Wolf ETF with the ticker LBO was listed at that point. Now, over those, what is this, a little bit more than 2.5 years, right, you can see that all three ETFs have underperformed the MSCI World index, and especially, well, most recently, right? Now, we can remove LBO because that simply then gives us a track record that goes all the way back to 2013. So now we can look at PEX and PSP, right? And we can see the performance again versus the MSCI World, right? But unfortunately, we do see a significant underperformance. We also see that most of the underperformance, right, at least the one from PSP, comes from 2022 onwards. And that's, of course, when interest rates started increasing, right? Because inflation was high, central banks are trying to battle that. And well, private equity companies are large users of leverage, right? When they buy companies, and it was very easy historically to show value creation, right? When cost of financing went down. And of course, if the opposite happens, if cost of financing goes up, that means negative value creation. Unless, of course, you can create value via operational changes. Now, the unfortunate part is not only that these two ETFs underperformed the MSCI World over this, well, 10 plus year time frame, it's also that they were much more volatile, meaning that from a Sharpe ratio perspective, right, they performed much worse. Now, finally, what we're going to do is, so far, we've looked at those ETFs, which, as mentioned earlier, provide exposure to private equity managers, right, the fund managers effectively. Now, we can also contrast that and to the performance of private equity funds. And so we simply added the Finominal Private Equity Index, which provides exposure to listed private equity funds. So now we have managers versus funds. Now what we do see over here, right, that over the same time frame, effectively it would have been better to invest in the funds rather than the managers. Difficult to explain this, why that is, multiple reasons. Perhaps investors and research analysts simply like struggle with valuing those companies because, frankly speaking, the assets under management in private equity have increased from like 3 trillion in 2013 to more than 5 trillion, right? And so there's way more money in private equity today than ever before. And that, of course, makes the poor performance of private equity fund managers, well, even more disappointing. That's it with regards to our short review of these private equity ETFs that provide exposure to listed private equity companies like KKR Blackstone. As mentioned, there's surprising little AUM in these funds, right? Less than 500 million. But we can probably also explain that by the poor performance, right? Historically, it would have been better to allocate to the private equity funds rather than the managers, right? Yeah, let's see how that turns out going forward. Hope that helps. Have a nice day.